Welcome back to The Explainer. I am super excited for today's deep dive because we are running a really fascinating healthcare stock through the absolute ultimate financial gauntlet. Today, we're putting on our expert investment analyst hats to look at AdaptHealth, ticker symbol AHCO. We aren't just going to glance at a few charts. We're going to completely stress test this company using the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, before capping it all off with modern discounted cash flow and comparative models. AdaptHealth is undergoing a massive, literally unprecedented expansion right now, and the numbers are throwing off some wild, conflicting signals. So we have to ask, is it a value trap or the opportunity of a lifetime? Okay, let's dive right into this. Here's our roadmap for today. We'll kick things off with a quick company snapshot, move into the Buffett lens, followed by the Peter Lynch lens, and then the Graham lens. After that, we'll build out our projections using DCF and comps, and finally, wrap it all up with a synthesis verdict. Section 1. Company Snapshot. Let's quickly get the lay of the land and understand what AdaptHealth actually does. They are a national leader in providing patient-centered healthcare at-home solutions. Think home medical equipment, CPAP machines for sleep apnea, continuous glucose monitors for diabetes, and oxygen therapies. All right, getting into the baseline numbers. As of June 18, 2026, AdaptHealth is trading at $9.65 per share, which gives it a market cap of about $1.285 billion. This makes it a mid-cap company operating in a sector that's becoming more vital every single day, as a ton of healthcare services naturally shift to the home. It's a megatrend we are all keeping a close eye on. Now here is where things get really interesting. Talk about some serious tension in their Q1 2026 results. On one hand, they just pulled off the largest de novo expansion in the history of the home medical equipment industry. They became the exclusive provider for over 10 million members of a new strategic partner, and that drove a really fantastic 9.1% organic revenue growth. But, the cost of this transition was steep. They posted a net loss of $16 million and a negative free cash flow of $27.5 million, mostly due to elevated labor costs and massive upfront equipment purchases. So we're seeing high growth, but a lot of short-term pain. Moving right along to Section 2, the Warren Buffett lens. We're looking for moats, consistent earnings, and stellar management. So if we run AdaptHealth through Buffett's famous checklist, honestly, it's a very mixed bag. The economic moat is actually quite strong. Securing an exclusive contract for 10 million members shows massive competitive scale. However, the rest of the checklist is pretty rough. Earnings are super inconsistent with that widening net loss. The return on equity totally fails this test, sitting at negative 3.46%. And then there's the debt, a staggering $1.82 billion in long-term debt. That alone is enough to make the Oracle of Omaha need his own heart monitor. On top of that, management is currently unsettled. They just abruptly terminated their chief operating officer in May 2026, right in the middle of this massive expansion. And then we hit this number, negative $27.5 million. This is their Q1 free cash flow, which we use as a proxy for Buffett's beloved owner earnings. See, Buffett wants companies that throw off cash, not consume it. Now, management insists this burn is completely temporary due to the expansion, but this current burn rate, especially when you pair it with that massive debt load, is just a huge red flag for Buffett's framework. So, the million-dollar question, would Warren Buffett actually buy AdaptHealth today? The answer is a definitive no. While he might appreciate the incredible scale of their new moat, the heavy debt burden, the negative owner earnings, and that management turnover, that completely destroys the margin of safety he demands. He would absolutely pass. All right, Section 3, the Peter Lynch lens. Let's see how this looks when we search for growth at a reasonable price. Now, what's really interesting about Lynch's framework is how he categorizes companies. And AdaptHealth actually straddles two different stories here. Are they a fast grower or a turnaround play? Well, on the fast grower side, they're hitting that 9.1% organic revenue growth and rapidly expanding their digital footprint with 412,000 registered app users. But then on the turnaround side, you have the terminated COO, the negative earnings, and the fact that they literally just had to execute a $1.1 billion refinancing to push out their debt maturities. Lynch actually loves a good turnaround story, provided the core business is still growing. But the real standout metric for Peter Lynch is this one right here, 0.23. That is AdaptHealth's PEG ratio, the price-to-earnings ratio divided by the growth rate. Lynch loves anything under a 1.0, and he considers anything under 0.5 to be an absolute screaming bargain. At 0.23, the market is essentially pricing this stock as if the business is dying, completely ignoring that 9.1% top-line organic growth. So despite the really messy balance sheet, this metric alone would make AdaptHealth incredibly attractive to a Lynch-style investor. Next up, Section 4, the Benjamin Graham lens. Let's see how it holds up for the strict defensive value investor. Let's run through Graham's super rigid checklist for the defensive investor. Adequate size? Yes, at $1.28 billion, they easily pass his $500 million threshold. Price-to-book ratio? Graham wants an under 1.5, and AdaptHealth is trading at a heavily discounted 0.85, so that's a massive pass. But then we hit liquidity. Graham demands a current ratio over 2.0. AdaptHealth fails miserably here at 0.71, meaning they have way more short-term liabilities than liquid assets. And earning stability fails again due to that recent $16 million loss. For a strict defensive investor, Graham would walk away right here. But, for the enterprising investor, we can actually calculate Graham's intrinsic value using his famous formula, the square root of 22.5 multiplied by earnings per share multiplied by book value per share. Now, because Q1 EPS was negative, the literal math breaks. So to run this fairly, we have to normalize it. Based on the data, the stock is trading at a forward PE of 10.34. At a price of $9.65, that implies a projected forward EPS of 93 cents. So let's use that 93 cents and their book value per share of $11.15 to carefully run the formula. Crunch those numbers, and Graham's intrinsic value comes out to $15.27. Compared to the current trading price of $9.65, that represents a huge margin of safety. So while Graham, the strict defensive investor, might pass because of the poor current ratio, Graham, the quantitative value hunter, would see a stock trading for roughly 60 cents on the dollar relative to its normalized asset and earnings power. All right, let's pivot to Section 5, hard projections. We're putting the historical gurus aside for a second to look at DCF and alternative models. Okay, let's look at the discounted cash flow sensitivity table. To fix the anomaly of that Q1 negative cash flow, we are using management's maintained full year 2026 free cash flow guidance. They are projecting $175 to $225 million, so we're just going to use the midpoint of $200 million as our base. Because of their heavy debt load, we're using a fairly conservative weighted average cost of capital, or WACC, of 9% and a standard terminal growth rate of 2%. If we just focus on the base case scenario right in the center, it yields a fair value of $22 per share. Now, let's cross-check that with a comparables model using the enterprise value to EBITDA multiple. AdaptHealth is currently trading in an EV/EBITDA multiple of just 5.56. If we assume a totally standard healthcare services industry baseline multiple of 8 times and apply that to management's midpoint 2026 adjusted EBITDA guidance of $705 million, well, the multiple expansion alone suggests a fair value near $28.50 per share. As an investor, you really have to ask yourself, is the market over-penalizing them for that debt? Finally, Section 6, Synthesis Verdict. Let's get to the final recommendation. And bringing all these valuations together brilliantly illustrates the whole picture. There is a massive disconnect between AdaptHealth's current price and its modeled potential. Across almost every normalized metric, AdaptHealth looks deeply undervalued. The strict Graham formula suggests a 58% upside. Our discounted cash flow model projects a 128% upside. And if it's simply reverted to a standard industry EV to EBITDA multiple, you are looking at nearly a 200% upside. The models are just screaming value right now. But we absolutely have to look at the context here. The risks are very real and they demand serious attention. $1.82 billion in debt is a staggering burden. Q1 cash flow was deeply negative, and that abrupt COO transition creates massive execution risk right when they need operational excellence to integrate 10 million new members. On the flip side, though, the strengths are incredibly compelling. 9.1% organic growth in a core healthcare sector, an almost unheard of 0.23 PEG ratio, and an aggressively expanding market footprint. So bringing it all together, our final impartial recommendation based purely on the data is this. AdaptHealth is a speculative buy. It outright fails Buffett's safety and predictability checks. He wouldn't touch it until the debt is paid down and the cash flow actually stabilizes. But for a Peter Lynch or an enterprising Benjamin Graham-style investor, this is a classic deep value turnaround story. If management successfully executes on their 2026 cash flow guidance and uses that cash to delever the balance sheet, the upside is simply tremendous for anyone willing to stomach the short-term volatility. So I'll leave you with this question to ponder as you evaluate your own risk tolerance. Is the short-term pain of AdaptHealth's massive expansion the ultimate buying opportunity, or is it just a debt-fueled value trap? The math definitely suggests the former, but the balance sheet is screaming a warning about the latter. Thank you so much for joining me on this explainer. Keep learning, keep analyzing, and I'll see you on the next deep dive.